To all of you. Good evening to all of you. Today we have here with us Padmaja Likhite Madam, Director, BSR and Company, and Akash Hapse, Manager, BSR and Company. The topic today we have covered is very, you can say, important with respect to the international transaction is concerned, because the reason of the importance of the topic is this topic we are using day-to-day life, day-to-day compliances. Thank you for accepting our invitation, Madam and Akash sir. I briefly introduced both of you. I first introduced Padmaja Likhite Madam. Madam is a Director, Corporate and International Tax at BSR and Company. She is a Chartered Accountant, member of ICI, over 13 years of having 13 years of experience in international taxation. Padmaja has wide experience in corporate international taxation, including consulting. She has international tax structuring matters, including various outbound, inbound investment structuring, cash repatriation, exit strategies, permanent establishment exposure, cross-border transaction like royalty, FTS, and other international matters. Advised, assisted on tax and regulatory requirements, ongoing compliance to various multinational and domestic clients from IT, ITES, manufacturing, and auto industry. Closely worked with some of the large US, UK, Europe-based MNCs having subsidiaries in India for structuring Indian tax operations, tax incentive planning, ongoing compliances, litigations, and as well as advising on complex issues. Advised on Indian exchange control and foreign direct investment rules. Representation before various appellate forums. She writes articles for tax research publications, online journals, and speaks on topic international tax matters at different industry and professional forums. I just now briefly introduce Akash. Is the second faculty of the day. Akash Hapse, Manager, BSR and Company, is a chartered accountant having more than 5 years of professional experience in international tax and regulatory service lines. Professional and industry experience. He has advised clients on various domestic and international tax issues, such as taxability of cross-border payments, analytics of permanent establishment, exposures, inbound, outbound, and investments, etc. He has also represented BNCs before different tax appellate authorities and handled domestic and international tax litigations. Advised clients on exchange control regulation in India and assisted in obtaining approval from the regulatory authorities. He has assisted various multinational companies in carrying tax and regulatory compliances in India and obtaining lower withholding certificate for nil or lower tax deduction. I welcome you both. I also welcome Sampada Kulkarni Madam for joining this session. Madam, this is a 10-day series and structured by our expert from the committee, Pranav. And also Ameya has helped a lot in structuring this series, Ameya Kunte. All 10-day series covers exclusively international taxation and transfer pricing. And today's very, very important topic which you are going to cover, that is on TDS. Issues on royalties, dividend, and fee for technical services. I welcome and I request all of you to please take a charge of the session.
Thank you so much, Rajesh Agarwal sir, for a nice, warm welcome and the nice introduction for all of us. We really thank the Pune branch of WIRC for this opportunity to take the session on a very niche and a very relevant topic in today's globalization world. which is withholding tax issues and the taxability of royalty, fees for technical services, and dividend paid to foreign companies. So as globally we are warming up and the barriers between the countries are getting almost vanished. There is an e-commerce era which is driving us. There is an online digitization transformation happening in, and India being a developing country, definitely we have been the large important importers of the technology and the technical know-how. And that's where the India back in 1976 introduced the deeming provisions qua the taxation of royalty and fees for technical services. Since then, it has emerged over the decades, be it an update in the treaties, be it a landmark updates in the domestic law provisions, and the landmark rulings coming from the different courts, including the Supreme Court rulings. And that's why when we are having the international platform for representing India on the global market, our collaboration with overseas companies and MNCs is increasing day by day. And that's why the taxation base are also getting evolved in light of the BEPS action plan, OECD Pillar 1, Pillar 2. And there, every time the royalty FTS taxation, which we call it as a fees for technical services, becomes a very relevant and important topic for tax professionals while advising their clients, industry players, while discussing the business decisions with the clients. And the tax leakages have to be adhered to on a very efficient manner. With this introduction and a background, I would like to directly jump into the topic and take us through the session. Yeah, so Sampada, requesting you to present the deck. Yes. So in next 1.5 hours, the target from our side is to take you through the niche important issues qua the royalty and FTS taxability in India, including the dividend taxation also, and then how the withholding tax implications play an important role. We as an Indian entities play as a payer role in case of such transactions. And then we will also take you through the recent legal precedents and the circular notifications which are impacting all these three transactions in the today's era. We can move to the next slide. Yeah, so let us start with the overview of royalty FTS as per the domestic provisions of the Act. Without having a further ado, I would just want to jump into the taxability of these royalty and FTS transaction under the domestic provisions of the Act. So to start with, why the withholding tax implications trigger in? Because as we all know, Section 195 under the income tax provisions talks about any person making any Indian or a non-Indian resident making a payment to a non-resident in respect of which could be a company, which is a foreign company, or an individual, or a liability or a partnership firm, in case of any transaction which is taxable under the provisions of the Act. Apart from the interest and other provisions, that transaction will be subject to a taxable withholding responsibility in India. That's why any payment that occurs to a non-resident has to be tested under this lens of the Section 195. And then in order to evaluate whether that transaction is liable, that sum is liable to the provisions of the Act or no, we have to directly jump into a main charging section, that is a Section 5, which is a very predominant section of our provisions of the Act, which talks about any income of a non-resident which is received or deemed to received in India, or accrued or deemed to accrue in India. For the definition of deemed to accrue in India, you have to jump into the Section 9, which provides the deeming provisions. So in a nutshell, if we have to test the taxability of a royalty or of FTS transaction under the provisions of the Act, it has to be divided into the three categories. First is the payment made by a government of India. So even the Indian government, subject to the section provisions under 115A, it is liable to be compliant with these provisions of taxability. So even a government payments are also liable to be taxable if they are accruing or deemed to arise in India. Then any resident making a payment to a non-resident has to be taxed in India if it is accruing or deemed to accrue arise in India. So basically, accrue in India is linked to the business or operations of that entity, and arise is again linked to that actual activities being conducted. So it doesn't stop at the only receipt basis, but you have to test it under the accrual rule also. But except in a scenario where a resident is conducting a operations outside India. And for that operations, it needs to make a payment to a non-resident. For example, the export agent appointed outside India to make a payment to that agent to vouch or scout for the new business opportunities or the marketing activities conducted leads to a source outside India. And accordingly, in case of such transaction, a resident making a payment to an export agent would not be liable to be taxed in such scenario in India. When it comes to a payment made by a non-resident to another non-resident, NR to NR transaction, again, most of the times it is a very, very obvious interpretation that transaction between two non-residents conducted outside India should not be taxed in India because it is not supposed to accrue in India. But in such scenario, if those transactions between the two non-residents are leading to a generating of a business or a profession or a profit from an Indian source, then definitely one has to look at the taxability in India. And if it is taxable under the definition of a royalty and FTS, then you are bound to do the withholding on even such transactions. So source outside India is a very, very critical situation which has to be looked at. And there are series of case laws and judgments on this line, mainly the Delhi High Court decision in case of Lufthansa, which has clearly held that in case of a German company carrying on a repair of aircrafts or activity in the overseas soil would not be taxable in India as long as it is not connected to the business or operation carried out in India. So that's a Delhi High Court decision. And after that, there have been a series of rulings which have interpreted this source rule in a very wide manner, which we'll discuss in ensuing slides. We can move to the next slide with this. So with this, setting the context or the very important baseline for the royalty and FTS taxability under the provisions of the Act, let us have a look at the overview of the tax rates applicable to royalty and FTS. So if we divide it in the two broad categories, in case of a non-resident, which is rendering a services to India, which is taxable either as a royalty or FTS, doesn't have a permanent establishment, or in a simple term, we call it as a fixed base in India, then you have to test this taxability under the two limbs. One is under the domestic provisions of the Act, which are defined under section 115A, read with section 195, which we just visited a couple of minutes back. And then you have to also test it under the tax treaty, because section 90 of the Indian provisions of the Act clearly allows you to adopt the tax treaty rate for any taxable transaction, which is an international transaction, as long as it is a beneficial to the assessee. And under the tax treaty, most of the tax treaties which India has signed, it is taxable under the Article 12. So I would like to just mention one more point. Interestingly, royalty FTS being such a relevant topic, unfortunately, the OECD, UN or US model did not have any specific article on this specific taxation of royalty and FTS. And that's where India had took a step ahead and defined the taxability of the royalty and the FTS under the provisions of the Act, and also series of DTAAs it has signed with various countries over the period. And the treaties generally which India has entered with provides the tax rate under the three baskets: 10%, 15%, and as high as 20% also. For example, India-Italy treaty provides a tax rate of 20%. And when it comes to the rate under the Act, I would like to invite the attention of the very important amendment that has been brought in the Finance Act 2023, where the domestic taxable rate under the Act for royalty FTS, which was earlier 10% plus surcharges, has been enhanced substantially to 20%. And interestingly, this amendment came in when the Finance Act was passed. The bill was passed and approved by both the Parliament. And unfortunately, it was not there in the budget presentation made by the Honorable Finance Minister. And in fact, due to this amendment, the treaty applicability for royalty FTS transactions becomes substantially important. And that's where we need to look at and analyze each royalty FTS transaction under the respective treaties. Otherwise, you would end up paying the tax at the rate of 20%. The non-resident would end up paying the tax at the rate of 20% under the provisions of the Act. So this is a category where if we conclude that there is no fixed base or a permanent establishment or a P of a non-resident in India, If we conclude that there is a P of a non-resident in India, then in that scenario, we have to move to the right side of the chart, and you have to test it again under the two provisions. Once under the tax treaty and then under the act. The tax treaty basically helps you to determine the P category. So there are three types of P under the treaty which are defined: fixed place P, service P, and the agency P, which are the predominant Ps looked at. And if you fall in any of these category, for quantification of your taxable income, of a non-resident taxable income, you have to again fall under the domestic provisions of the Act, which is defined under Section 44DA. And interestingly, here you have a gross, instead of a gross basis, a net basis taxation base, where the income of a P can be taxed on a net basis, that is a net profit generated by the P, at the rate of 40% plus surcharge or cess. So though the tax rate is higher, as high as 40%, but you have a plus that you can derive the net profits after knocking off all the expenses and pay a tax only to the extent of net amount at the rate of 40%. But having a P in India and accepting a P leads to consequential series of compliances, be it a maintenance of books of accounts, be it carrying the audits of the books, and then be complying with various, compliances qua the transactions carried out where withholding implications arise on any payments made by the P. So generally, we never advise the clients to blindly or easily accept a P concept, but test it, ring fence it, and have a housekeeping measures to come out of the P net and fall under the gross-based taxation. And when you are into the gross-based taxation of royalty FTS, you have other exemption exclusions that can be explored under the provisions of the Act as well as at the treaty. We can move to the next slide. So having set the context for the royalty and FTS as a concept and the taxability treatment under the provisions of the Act, let us deep dive into the nitty-gritties and minor important points about the royalty taxability under the domestic provisions read with the treaty. Section 916 of the Act, which was been introduced long back in 1976 by the finance budget of 77 and 78. Then in that scenario, the royalty has been defined very broadly under the provisions of the Act. And definition was made as wide as possible and not let any corner unturned to cover any copyright or any equipment related transaction, any scientific data exchange, any trademark exchange, where even like transfer of any or all rights pertaining to a patent, invention, model design, secret formula, for example, imparting any information which is technical in nature, industrial in nature, and which is very commercially exploitable information, or even a use of such information for further business developments would also fall under the purview of the royalty. So the definition difference we have to keep in mind under the Act is that it talks about all or any rights. And it talks about not only a copyright, but all or any rights, and even a use or a right to use, even a equipment provided by a non-resident party to an Indian recipient may trigger the royalty taxability in the hands of the service provider or a non-resident service provider. And that's where it becomes very critical to look at the definition of the royalty under the domestic provisions of under the treaty as well, and to come out of the taxable net if possible. So with this background, let us look at some of the important changes that has seen this 916 section over the years. So basically, prior to 2012, there have been a series of decisions on the software taxation, or that for that matter, data processing, or the satellite related transgender transponder charges and other transactions where the taxability was very, very litigative in the hands of the assessees. And there was a set of high courts, like Delhi High Courts have been giving a favorable ruling, especially in case of a software taxation. And Karnataka High Court's rulings were coming against the assessee qua the taxation of a software or other related transactions. And after looking at this controversy, which has been leading up to the High Court level, the government actually took a draconian step in 2012 by the Finance Act, and they made a retrospective amendment to make certain changes in this taxability. and whereby the intention was to settle the litigation and the kind of a discrepancies in the views and bring it aligned that use or any use of right to use a computer software, whether it is a program, whether it is electronic data, whether it is embedded on a disk or otherwise or any other hardware, it has to be taxed in India. Then explanation 5 kicked in, where it says that it always included that any right, property, information, whether the possession of that property or a right is coming to the payer or no, whether it is directly coming in India, the location of that property is in India or no, because there have been transactions where the two non-residents, in a case of an e-commerce era, where the digital platforms are used, and every time the any data or any online software or a product may not be physically present in India. And that's where the tax payers were taking a shelter of an argument that technically there is no property that is moving in India or a right being exploited in India, so it should not be taxed. But all these kind of controversies were set aside, and then it was said that irrespective of the possession, right, or any control of the information coming directly to the payer or in India, as long as it is an exploitation for the Indian operations, it should be taxed. And similarly, the processes definition in case of a satellite era is always supposed to include that even a use of a transmission, use of a satellite for the transmission of a data, be it a downlinking, uplinking, or any other kind of a connectivity, where the internet network or the phone in relation to our phone calls, where there has to be a data passing on through the fiber optic networks in case of a software being online disposed of by the SEZ units. All these transactions which gives a right of transmission of a data would be taxable as a royalty. So this has been a very, very draconian move by the Indian government, and bringing under the tax radar, under the radar of TaxNet, of series of transactions from the software to the satellite related moves. And that's where it becomes more crucial to look at the royalty definition under the tax treaty. And here we have to look at, while there is no specific article, but there is a discussion under OECD model as well as UN model, qua the royalty definition, and which all the transactions should fall under the purview of royalty. So for that matter, OECD model is comparatively lenient. The definition is narrower, which talks about only a copyright in any literary, artistic, or scientific work would come under the definition of a royalty. Again, a patent trademark, where a copyright of that patent or trademark should be moving to the service recipient. And when it comes to information concerning industrial scientific experience, again, it is a use or a right to use a information concerning. So for example, the copyright or a patent definition is narrower, but the information concerning industrial, commercial, scientific experience. So if you are exploiting the information available in the public domain through any subscription charges or any such facilities, it becomes very crucial to look at whether it falls under the definition of the royalty under the treaty. And secondly, the UN model definition is more or less on the same line, but the major difference is that it also includes use or a right to use industrial, commercial, scientific equipment. So, for example, India-US treaty, which is in line with the UN model, contains this specific definition under the royalty article. So, this gives a emerging view to the royalty, the equipment royalty concept, which is clearly driven by an infrastructure present in India, which has been accessed by the Indian recipient and which has been controlled and managed by the non-resident service provider. And that's where the royalty kicks in qua the equipment related usage. And here, most of the treaties are having a more of OECD model language, but few treaties, and which are the more popular treaties like India-US, do also follow the UN model concept. And that's why it becomes very pertinent to look at the definition under the respective treaty. So with this technical backdrop, maybe let's look at the few case studies which we have put together for ease of understanding, or main issues which are emerging from the royalty taxation and which is relevant from the withholding perspective. Because an Indian payer, whenever taking any services from the non-resident, it has to test the taxability of that transaction, be it a group entity transaction or a third party transaction, to determine the taxability. under the definition of the royalty under the Act as well as treaty. And let's look at these 6 eminent issues and the decisions which have been generated, which have been passed in this line. So start with the very interesting and the very close to our heart topic is over the shrink wrap software or a shell software, because as you all know, in 2021 there has been a Supreme Court ruling, and I believe there have been a digital taxation session conducted yesterday by CM Hitesh Thakkar, and he would have touched upon it. But I believe that royalty topic is not complete without talking of this Supreme Court ruling and other connected issues with this ruling, which has led to a series of controversies over the years, and which were settled by a very good decision by the court pronounced in 2021. So in nutshell, any standard software which is not customizable, which is downloaded online or embedded on the hardware, either scenario, and is treated as a product and not as a royalty, because the one the recipient receives is the right to use that product or download that software and apply it in its business operations, and not to exploit it to make any decoding or any coding related changes. And this has been upheld by the Delhi High Court decisions in case of Nokia, Ericsson. Karnataka High Court in case of Samsung has reversed, or rather gave a adverse view on this and treated it as a taxable as a royalty under India-US treaty. But to set this aside, set to the rest all these controversies, the Supreme Court, which heard almost 60 plus assessees in a one go quasi software taxation, which we'll discuss in a bit in next slide, has given a favorable ruling, and which kind of becomes a law of land after the ruling, quasi software taxation. Next important part comes the right to information or industry allowing access to business information and reports. This is again very common example in our day-to-day operations, because all of us where the data and the knowledge has become a critical part of our lives, and accessibility is available through series of sources online available, be it a website, be a business journal, be it a newspaper giving a good subscriptions to provide a very niche and the editors read to the assessee. For example, we have a series like Tax Sutra or Taxman, or series of specialized tax related knowledge websites and platforms, which gives you a series of information available, which is either aggregated, processed, and then presented to the recipient. So it comes to a point that whether imparting of such knowledge, information, experience, whether it is taxable as a royalty or no. So in this case, we have this 2 different views emerging from the series of case laws. To talk about the first ruling was LSV or BV in case of AR Mumbai, where it was clearly held that payment made, for example, in case for a database, science-related database access containing the books, journals, articles, with the limited right of printing it, making copies, and storing the information, is not taxable as royalty, because you are not getting the exploitation rights. Whereas in case of Dun and Bradstreet, where the Indian entity was again processing the data and preparing the business information reports, which for the parent entity as per their instructions and as per their guidance. So in that case, whether the payment made to the applicant, that is a parent entity which was actually leading the processing techniques or compilation techniques for generating such reports, whether it should be taxable as a royalty. The conclusion was that it is not taxable as a royalty, but it is taxable as a business income of the overseas entity, which is actually compiling and processing the data to generate the business reports. And since it is taxable as a business income, and in absence of a permanent establishment of overseas entity in India, it should not tantamount to any taxable transaction for the non-resident. Similarly, when it comes to the auto industries, that engineering, design, drawings becomes a very, very important part of their day-to-day operations. And they appoint the non-resident expert people to develop certain design. For example, architects do develop such designs and, pass it on to the service recipient. And in that case, whether it is important to evaluate whether it tantamounts to a royalty or no. And in that scenario, if the drawings and design are an integral part of equipment, as held in this first decision of Neyveli Lignite Corporation, that if it is a part of a equipment, then it should not tantamount to a separate taxability as a royalty. But if it is distinguishable and the rights are, or the drawings are passed on in such a manner that can be exploited or modified by the recipient, then it may be treated as a transfer of a copyright. Similarly, in case of a next decision, it was relating to the Mitsui Engineering and Ship, where it has been held that the design, which is an integral part and cannot be segregated from the main equipment that has been provided, then you cannot distinguish and separately treat it as a royalty, and it has to be treated as a business income or a sale of an equipment or a sale of a product income. And that's why it should not be taxable. The fifth category talks about the satellite transponder payments. Again, this has been when the last 10 to 20 years, when we have seen emerging trends of the network connectivity, be it internet connectivity, or be it 5G, 4G evolution coming in the telecom industry, where the bandwidth charges, the Netflix, Amazon, all these has seen a kind of a outburst after the COVID scenario, where there has been an online transmission of the data from the overseas to the Indian users through the intermediaries, and such kind of uplinking and downlinking of programs for the TV channels or by the TV channels. Whether that tantamounts to a royalty or no was a question. And there have been a series of decisions as put on the right side. And in fact, Verizon Communications was an adverse decision, which has been passed by Madras High Court in 2013. And that has been a very, very aggressive and adverse ruling pronounced by the government. And actually, there have been no transfer of any rights qua those data which has been transcribed and generated through the satellite and transponders. But just there was a right to access that data through the satellite mode was given to the Indian recipient. It has been treated as taxable. And this decision after this has been followed in series of other tribunals as well. So this kind of rulings have been emerging, and each treaty gives you a handle to come out of the taxable net by evaluating your taxability under the respective treaties, basically. And when it comes to a sixth point, another argument in case of a royalty that has been seen is that apart from the category of defining it as a royalty or no, the taxation has to be made on an accrual basis or a payment basis. So interestingly, few of the treaties like India-Japan treaty has the language that the royalty will be taxable or withholding is liable to be done only at the time of payment and not at the time of credit. So if you are accruing any income which is payable to a non-resident, and subsequently you are returning it off, so you are not liable to do the TDS either at the time of accrual nor at the time of payment. So this is an interesting decision and recent one, Faber-Castell, it is a India-Germany DTAA, which has come recently. And this has been held by the, this has followed the Siemens Bombay High Court decision, which was the older one, where it has been said that the royalty taxation is driven by the payment method and it can't be mandated to the TDS at the time of accrual. Again, a very interesting argument, still sees a lot of controversies and open for interpretation. We can move to the next slide with this. Yeah, again, a small summary that in a layman language, if I had to see whether any transaction with the non-resident is liable to be taxed as a royalty or no. For example, let's take an example of a books or a medicine. The manufacturer, what it receives is a patent to manufacture. So clearly there is a copyright of manufacturing being passed on, and that's why it's royalty. Whereas a distributor or an end customer gets a final product of that medicine. So what it pays is the price for the product and not the royalty. Same goes with the books. For example, we have so many series of books of Taxman or any other good publishing books that comes in. What the author gives a right to the publishing house is the copyright for producing so many copies. And in charge, author gives the royalty based on the number of copies being, produced or manufactured and sold. Whereas the end customer or a distributor gives the price for the final product or a book, and it doesn't have to withhold the taxes on such transaction. Same is with the packaged drinking waters, or in case of the technical equipments like as simple as the washing machine, that, for example, Siemens give its manufacturing right to its Indian subsidiary, then definitely it's a license for the manufacturing, which is definitely taxable under the treaty. But if any distributor or enters into a buy sell model, it just imports and then distributes to the end customers or any other second line of distributors, then definitely it is taxable as a price, because it doesn't get a right to exploit or make any technical changes in that product. So with this, we can move to the next slide. And yeah, so I would just spend a couple of minutes on the engineering analysis decision, which is kind of a next Bible on the royalty taxation, which will be discussed for next few years at least. In nutshell, what the Supreme Court upheld, or rather referred to the Copyright Act, and concluded that in case of a series of a direct sale of a software by the non-resident to the Indian end user, or a sale of a software by a NR to Indian distributors who are in turn selling it to the third party end customers, or a sale of a software by a NR to foreign distributor. For example, there is a US entity, there is a Singapore entity who acts as a distributor, and the Singapore entity then passes on that product to the end user in the India or a distributor in India. And in this scenario, even a software which is which is bundled with the hardware, like a CD or any other product which imbibes that software into it, in such kind of a sale of transactions by a foreign suppliers, all these four categories are covered by the Supreme Court ruling. And the basic principle that has been applied on all the four categories is that what the recipient is getting in any of the scenario is a copyrighted article, and not a copyright in that article, which remains with the owner, is definitely a sale of product akin to a copyrighted goods and not a copyright. Even if some rights of making a copies or a backup are still covered and should not lead to infringement or a disturbance or exploitation of a copyright. And in this scenario, they refer to the Copyright Act definition under the Indian copyright clearly, which defines when you get a copyright and when you get a copyrighted product or a good. And that's why it becomes very critical in any case of software transactions to look at the end user license agreement, which is entered with the main supplier by either the distributor sitting in India or any other country. And then the end user, right? The end user also gets a product or a copyright which is downloadable or directly sold along with the hardware, either scenario. So this has been a very good ruling that has Indian judiciary system has seen in last many years, and it will definitely lead to a settlement of a controversies. But having said so, Indian government did not stop after this, and there has been a petition which has been review petition which has been filed by the authorities, the revenue side, with the court, saying that the decision which produced looked at the 60-70 cases were very fact specific driven, and hence it can't be blindly or blanketly applied to any of the software transactions, saying that it is not taxable in India. And that's why we do agree to that extent to this observation of the Supreme Court, the review petitioners, that this is not a blanket non-taxation of software in India. You have to look at each fact pattern, how what Indian recipient is receiving is a copyright or a copyrighted article or other way around, and accordingly give the inputs on that basis. And another point I would like to touch upon here before we move further is that while the software taxation has been put to rest by this ruling, it also opens another Pandora box of the equalization levy for software taxation. And that's why equalization levy, which has been levied by the Indian government 3 years back, and it is still intact. So if you are out of the taxation net of software, you are still liable to equalization levy or no. And the significant economic presence, which is another concept which is similar to the permanent establishment under the treaty. So these angles also have to be looked at. We can move to the next slide with this. Yeah. So we can just quickly cover the recent couple of rulings which have come after this Supreme Court ruling has been pronounced. And let's look at this ruling which has been as recent pronounced by Delhi Tribunal in 2023. which talks about a healthcare information available in public domain and created database which has been maintained, and the consideration paid whether by the Indian users to access this data, this information, which is maintained by the US MNC, whether it leads to a taxability as a royalty or no. So in fact, though the role of the US MNC was the aggregator, they did some kind of modifications to that data analysis, indexing, description, and so on and so forth. But the essence or the main intact of the copyrighted product remains the same, and that's why the conclusion was that there was no transfer of copyright in that information or a data that never came to the US MNC, so it can't pass it to the Indian users, and that's why it will not lead to a taxability under the DTAA, and that's why, especially in absence of a PE, it is hello.
Hello.
Yeah, am I audible?
Yeah.
Yes, ma'am.
Yes, yes.
Yeah, okay. So, Sampada, should we move to the next slide? Okay. Yeah, I just switched on the video just to ensure the bandwidth. Again, network challenges should not be faced. Okay. So the next decision talks about the annual license fee paid for procuring the software centrally and the recharge it to the Indian entity. Again, a very classic example we see in a lot of MNCs, that a parent entity procures a software centrally and provides the right to use that software to its subsidiaries across the countries, and main parent entity pays the software charges, the kind of a copyrighted article charges to the main supplier. So in this scenario, what Indian entity pays is kind of a reimbursement of the cost incurred by its parent entity. And in this decision, unfortunately, it was not accepted, the arguments were not accepted, and it was held that this is taxable as a royalty as well as a FTS under the treaty, and that's why the withholding has to be done. Sorry, I think we lost Sampada. Yeah, I think that presentation has gone. Akash, do you have the
Yeah, Padmaja, I'll just share
Sure.
my screen for that.
Yeah.
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 Is my screen visible?
Yeah, it's visible. It's visible to all, right?
Yeah, it is visible.
Okay, perfect. So in this scenario, I would like to highlight one angle, that when a cross charges of such software fees happens from an Indian subsidiary to the overseas But I would like to highlight that this argument doesn't sustain these days, because any transaction, had it been directly done with the third party supplier instead of a overseas parent entity, then definitely it would have been taxable as a royalty. So just by saying that it's a cost to cost reimbursement doesn't sustain, but the argument you have to take that is that it's a copyrighted product access right which has been received by the Indian entity, and it has never got a copyright in that product, because parent entity itself is using a copyrighted article. It doesn't have a copyright at its disposal. So it can't pass on something which it doesn't possess. And that's why it should not be taxable. Again, this is not a good decision, but there have been a series of favorable rulings on this decision as well. We can move to the next one, Akash. Yeah. So again, I think a very interesting and a relevant decision in case of the taxability for a software embedded in the hardware, where this is in case of a Park Systems Mumbai Tribunal 2022 decisions, where a hardware and software were provided together, and it was a part of an entire equipment that has been supplied to the assessee, and it was for the product or a software the consideration was going, and that's why the assessing officer said that though the software is embedded in the hardware, the software carries a more integral part of the payment transaction, and that's why it is liable to be taxed as royalty. However, the tribunal held in favor of the assessee and against the revenue, saying that the software which has come with the hardware is actually a copyright that has been passed on to the Indian entity, and no copyright in that product has been passed on. It's a copyrighted product that has been given, kind of a equipment. And especially if you are not able to demonstrate a P of an overseas entity in India, it will not be taxable as a business income either. Yeah. So with this, we covered the key areas of royalty taxation, and we are at 5:51. Definitely a quick time check. And maybe should we take few questions on the royalty first before we move on to the fees for technical services? So I can see a question in the Q&A box from Mr. Praveen Jain, that while preparing a Form 15 CB, if PE exists, how can we as a CA determine the net basis to deduct the tax at the rate of 40%? Very, very valid question and a very practical point that has been highlighted. So the moment if there is a PE, first of all, we are signing as a Form 15 CB, then technically, without doing the analysis of the profit attribution and the taxability of the income on a 40% tax basis, you may not be able to declare the correct income. But what we have practically seen clients have been doing, that generally the CAs prefer, or the payer prefers to do the 40% on a gross basis if the net basis working is not provided by the non-resident payer, non-resident recipient. So in that scenario, most of the times it leads to a highest tax of 40% on a gross basis. And later on, when the non-resident chooses to file its return of income in India, they can do the net basis working and claim the refund of the balance amount, which has been deducted on a higher side. Hope does this helps helps to answer your question, Praveen sir. Should we wait for a few more questions, or should we move ahead, Agarwal sir?
Madam, we will move ahead, and at the end we will cover the questions.
Sure. So we'll just take the next part of the FTS taxation. So FTS taxation is another interesting area, and that has seen a series of, again, ups and downs in last few years. And let us look at the FTS, or which is largely known as FIS under the definition of the Act. 917 of the domestic provisions of the Act defines the FTS, which mainly includes a consideration for rendering managerial, technical, or consultancy services, and it also includes the provision of services of technical or other personnel. So interestingly, again, there is no specific definition of managerial, technical, or consultancy which is there under the provisions of the domestic provisions of the Act. However, we have to look at the various legal precedents, and the OECD Technical Advisory Group report also defines the managerial word in a more detailed manner, which has to be looked at. And while these are the three broad categories, there are exclusions provided for consideration of construction, assembly, and mining or like project, because there is a presumptive taxation section specially to treat such transactions. And then also the salary income is not covered, for the obvious reason, because there is a separate code for salary taxation. With this, let us decode all three categories of managerial, technical, and consultancy in next slides. Yeah. So as I mentioned, we have to rely on the dictionary meaning and the interpretation from the various courts and the tribunal judgments that has been pronounced on this matter. Managerial word evolves from the function that is how the business is run, or how the business is managed, or actually the functions are carried out. For example, hiring, training the people or the commercial agents would lead to a management activity, and more of a marketing age, managing the marketing function of a company. Again, it's a managerial role, and it involves controlling, directing, administrating the business. And it also derives more of a significance of the management of affairs of the company, and it directly leads to the direction of adoption or carrying out the policies of the organization. So these people may not be technically qualified. They are not, they might be having a master's degree or a management degree in those categories, but they may not be having a niche technical qualifications, but they are overall responsible to manage the people who are performing the actual technical work. For example, there are series of decisions. For example, in case of films, there is a crew that has been appointed for shooting the films, which is conducted outside India, to identify the location, accommodation, and all those facilities. So there are managers appointed by the stars, directors who to look after such activities. So they are more of a managerial role, and not of a technical or a consultancy role. And when it comes to technical, it clearly possesses about the, it clearly talks about the possession of a specialized skill, knowledge, or a particular art, science, like accountancy, architecture, medical as a profession. All these people are super technically qualified, and they deliver in that category, and that's why it qualifies as a technical service. When it comes to consultancy, it is more of a advisory role or a strategic consultancy about the business, its business plans, acquisitions. And so there is a kind of a thin line of interplay between the technical and consultancy, because we as a, for example, CA professionals, we act in a both capacity. At times we are acting as a technical advisors, and at times we advise in a consultancy, we advise as a technical professionals to file the returns of the clients, and then we act as an advisor also for their structuring their tax or the business matters. So that's why technical and consultancy is used interpersonally, and accordingly has to be looked at. And secondly, in case of a technical, there has to be a human involvement, which is very must, because without human intervention, you can't deliver a high scale technical service. And there is a very famous decision in case of SkyCell Communication of Madras High Court. Then there have been a series of decisions, including the Bharti Cellular Supreme Court decision, where human intervention is very, very critically looked at and has to be importantly interpreted. For that matter, Bharti Cellular went into the definition that you have to see at what level and what stage the human intervention is done. And it is not just to operate a button or just to switch on, switch off the entire operations. It has to be a very significant contribution done through a human intervention. Then only it can be qualified as a technical service. When it comes to the consultancy, again, we have a OECD tag report which talks about it is an overlapping category, and that's why it has to be very, very clearly looked at the definitions under the treaty and the respective MOUs provided in this context. We can move to the next slide with this brief introduction about these three categories. Yeah, so this we discuss about the act, which is a very wide definition, and anything and everything can come under the category of either managerial, technical, or consultancy. But when it comes to treaty, the definition is more or less on the same line, but there are 2-3 distinguishing important factors which have to be looked at. And mainly, the most of the treaties are having they either carry a technical word or a managerial word in their definition of the FTS. So you have to look at the definition very carefully, and it is called as FIS, fees for included services, also in these treaties. And that's why that interpretation is very crucial, that whether managerial word is absent in certain treaties. And secondly, if your service is in connection with the, or it is ancillary or subsidiary to the main application or enjoyment of a property or a right, then definitely if that main equipment or a right is taxable as royalty, then your subsequent ancillary service also would be taxable as a FTS. So there has to be a linkage of the service and the main equipment or a copyright which has been provided taxable as a royalty. And this is a scenario in case of India-US treaty. And most of important part of the FTS taxability is of the make available transaction or make available interpretation view, which is emerging from the series of treaties like UK, USA, Netherlands, Cyprus, and so on, where it is clearly said that when a service recipient is able to apply the knowledge on its own without a recourse to the service provider in a subsequent period, then only it is treated to be making available the technical knowledge, experience, or a skill. And in that scenario, it then falls under the definition of FTS or FIS under the treaty as well, and then it is taxable. So this is a very interesting observation, and that's why the interpretation of the make available becomes very crucial, and which we wish to discuss through case studies in next few slides. So yeah, on this slide, let us look at what does that make available means. So it is very beautifully explained under the Memorandum of Understanding of India-US Treaty Article 12, and which talks about when a person acquiring the service is enabled to apply that technology on its own, then you are making available. There is no recurring nature of a transaction that is required once the technology is made available to the service recipient. And that's why the criteria to test is that the recurring nature and application on your own without a recourse. So simply rendering the service may not qualify that it is a FTS. So any technical service rendered by a engineer or an architect sitting from overseas, by default it may not, just because he's a technically expert person, by default it doesn't make a FTS. The service which is received should stop the further interaction of the service provider and recipient in the future. And there has to be an application by the recipient on its own without a support from the service provider. And that's why mere technical input or just, it embodies the technology, the service which provided embodies the technology doesn't make it as a make available. So you have to, any technical service by default doesn't make a make available concept test pass. You have to test it individually for the fact pattern. We can move to the next slide with this. So on the FTS and FIS taxability, let us look at the emerging key issues which we have to look at when you have to test their taxability and take a decision on a withholding perspective. So certain treaties doesn't have the term managerial service in itself. So in that scenario, if there is a managerial term is absent, then definitely you fall out of the FTS and FIS definition if you are not a consultancy either or a technical also. But at the same time, you have to be tested, your services have to be tested under the other articles like the business income article, under Article 7 read with Article 5, whether you have a PE in India or no, and the residuary article of income from other sources also. So there is a ruling of Invencis Systems, which is a pretty old but very good ruling, which clearly takes you under the tax net because of this absence of the managerial term in your treaty. So you have to read the treaties very carefully. Secondly, as we discussed, human intervention is a very important fact pattern or a factor for technical services testing. And as has been pronounced by the series of decisions, including the Supreme Court decision, a human intervention or a contribution at what stage, at what level, what is the significance of that contribution is something you have to test. And this has been beautifully discussed and explained in the case of a Siemens decision as well. So that is something has to be done, that in case of a laboratory testing activities conducted, if that analysis that has been conducted needs a important role of a human analytics or a data analytics, then definitely it qualifies as a technical. But if it does not, then it would fall under the definition of the technical. Then certain treaties, interestingly, do not have the FTS and FIS clause as well. We will discuss a very recent decision in case of an India-Dubai treaty in this case. And if you don't have this article in the treaty itself, do you fall completely out of the tax net, or you have to still test under the respective other heads of income? We will discuss in a bit. And then the last category is about interplay between FTS and the service fee. So I'll just like to spend 1 minute that peculiarly India-US, India-UK treaty has a language where the service fee is defined that if any transaction is qualifying as a FTS, then you don't fall under the category of the service fee in that treaty. So interestingly, you pay taxes by FTS at the rate of 10% and you come out of the P service P category fully. So this is a very interesting observation. So you have to see the interlinkage of the FTS with other articles also, so that if you fall out of the FTS article, then the other articles, do they protect you or do they expose you, becomes a more crucial angle. We can move to the next slide. Again, I think a interesting angle that technical services cover professional services or no. So there is a very interesting guidance available under the UN Models Tax Convention that any services which are regulated by professions, like in India, we have the lawyers, we have the chartered accountants, we have the engineers, which are defined by the specific category of the professionals. There is a body governing these kind of professionals in each country. Then definitely what the payment is made for the consuming those professional services obviously would qualify as a technical service. But I would like to give an example that there are series of decisions that an auditor who conducts the audit of an Indian company, for example, an overseas auditor is appointed for some global requirement, and if he conducts the audit, which is he's doing in a capacity of a professional chartered accountant or an auditor, but he doesn't give any kind of a technical consultancy advice in that audit report. He just verifies the records and pronounces his views. Then you can still argue that it is not in nature of a technical service and still can come out of the treaty, come out of the taxability under the special treaty language. And there are examples under the domestic provision between the two residents. If the transactions happens, we look at the section 194J, and we see that if the technical service can get covered or there is no exclusion for the professional services. And that's why any payment made to a chartered accountant giving a tax advisory or a consultancy or a business advisory services, we generally tend to advise our clients to do the TDS at the applicable rates. But this is an interesting distinction between the 194J and the overseas transactions, where you can look at the respective treaties language and take a different view possibly. We can move to the next slide with this. Yeah, so let us look at the case study on managerial and technical services. This is again a 2018 decision in case of Edamol, South Africa versus DCIT, a Mumbai tribunal decision. Again, a company, the assessee was a producer and facilitator for coordinating of filming in overseas countries in South Africa. It arranged the local crew, transportation, paperwork for various requirements of a Indian producer or a Indian production house who went there for the production for the movie shooting requirements. And that when it was held by the tribunal, where the assessing officer said that such kind of a payment made to a South African line producer should be taxable as a managerial services, what the tribunal held that managerial services means doing a controlling, directing, or a managing activity. But in this case, it was more of an administrative role and not kind of a consultancy or a kind of a value add that has been done by the South African company. And that's why such kind of a logistics arrangement does not lead to any technical knowledge, skill, or imparting of any other technical expertise to the Indian recipient, and that's why it should not be taxable. Again, a very welcome and an interesting observation about how to distinguish a coordination activity from the managerial activity. We can move to the next one. And next case study is again in case of the Kalpataru Power Transmission Ahmedabad Tribunal decision, where the assessee was engaged into the engineering and procurement and EPC contracts, and it procured the services of the UAE-based company for designing of the drawings and designing required for manufacturing of its towers for its EPC contract business, and the tax was not deducted, interpreting that there is no any technical know-how that has been passed to the Indian recipient, while the revenue held that it is taxable in the nature of royalty, and that's why non-withholding attracts the 201 proceedings for the non-deduction of taxes. And what has been held by the Ahmedabad tribunal is that yes, this is a technical service, but there is a FTS article absent in the India-UAE treaty, and there is no P of an overseas service provider, UAE service provider in India, and that's why the business income is not taxable in absence of a P, and that's why it should not lead to any adverse tax implications for the UAE service provider in India. Again, a language of the treaty is very crucial, and you have to test it under the other articles as well. We can move to the next case study. Yeah, again, this is a very interesting and again in line with the source rule concept for the FTS taxation, that where the overseas, the agents are appointed in overseas for doing the marketing and the marketing of the courses which are led by the Sharda Educational Institute. This is a Delhi tribunal decision. The agents appointed were overseas, they were non-resident, they were doing the marketing of the Indian trust curated courses, and it was leading to generating a business or an income for this Indian trust from the overseas sources, and that's why it was concluded that it is not in nature of the technical consultancy, and it also falls under the exclusion clause due to the source rule being applied, and that's why it should not be a taxable transaction in India. Yeah. We can move to the last few case studies on the make available concept here. And again, make available being very, very interesting and the debatable issue. And that's why I would like to cover few case studies or the case laws on this matter. And we would like to touch upon the recent decision of the Calcutta, not the old decision of the Calcutta Tribunal, the older one, but still it talks about a generation of an opinion or a form or a report, which is a normal activity of any business consultancy firms these days, and whether such kind of a reports are utilized by Indian company and they take the decision for investment actions to be made basis these reports. And what is done is that actually a generated report based on the data analytics is provided to the Indian company, and there is nothing technically made available to the Indian company to exploit such activities on its own in future. Every time it has to go back to that service provider to obtain such reports, and that's why it should not lead to a make available concept taxability in India. I just have a quick time checks. We are on time, right, Agarwal sir?
Yes, ma'am.
Yeah, we can cover till 6:45 for the next few topics, and then we can open it for Q&A. So that is fine, right?
Yes, ma'am.
Okay, we can move to the next slide then. Yeah. So again, a decision in case of US technology resources, again on the same line, that engineering services being provided and the management, this is actually an adverse decision where it has been held that the engineer services are received by an Indian entity from its parent, the customer in India, and both the Indian entity and the service provider, its parent entity, are engaged into the engineering activities. And what Indian entity was receiving are quality reports and the details of the technical expertise, which it was able to apply on its own while rendering the services to its third-party customer. And the service providers, senior management people were involved in the decision-making activity of the Indian entity who was rendering the engineering services. And here it fall under the category of the managerial services as well as making available the technical knowledge or the expertise of the quality reports and everything by the overseas entity. But at the same time, the argument that upheld or that was accepted by the tribunal was, it was a factual support that was given. Managerial role was performed by the parent, but technically there was no transfer that has been happened of the information and skill. My bad, this was a favorable ruling which has been upheld by the Kerala tribunal and then subsequently by the High Court as well. And that's why being a managerial services but not making available technical knowledge or skill, leading to a positive favorable outcome for the assessee. We can move to the next slide with this. Yeah, an interesting decision in case of Foster Wheeler, France. which is a 2016 a Chennai tribunal decision, which clearly talks about a customer providing engineering services, and for that non-resident company was entering into a contract with its another parent US entity. Similarly, here the ruling has actually gone against the SEC because the parent entity was executing the plans, everything schedules, and providing it to the Indian subsidiary. And Indian subsidiary was using it as it is and making some changes at its end for the project delivery. And there have been some budget related work activities that has been conducted by the parent entity for the subsidiary, which was adopted as is basis without making further ado, and then exploitation rights were also given. So technically, parent entity actually passed on its IP to the Indian subsidiary to deliver its project to the customer, the third party customer. And that's where it has been treated as a taxable. But interestingly, if you see, the payment here was made by a France entity to another US entity, and the services were indirectly consumed for the Indian customers' delivery. So while source rule could have been applied here and said that the technically whether the source is in India and that's why it is taxable in India, but the decision did not go into that direction. And it actually said that it making technical knowledge available between the two NR transaction between two non-residents, and that's why it is taxable in India. We can move to the next slide. Yeah. Another interesting decision in case of Flipkart Intranet, which is a 2000 very recent Karnataka High Court decision. And this has come after the Northern Operating Supreme Court ruling, which had come few months before this decision, which talked about the secondment arrangement taxability under the GST provisions, but it also touched upon the income tax provisions in that Supreme Court ruling. And that actually concluded that kind of a secondment arrangements are taxable for GST as well as for income tax purposes. But the Flipkart Internet decision came just in time after that decision has been pronounced. This is a Karnataka High Court decision, and interestingly, Karnataka High Court decision was favorable to the SEC, where a secondment of the employee has happened to India from the overseas, and what it was paid by the Indian entity was a reimbursement of the salary cost of that seconded employee. And in such kind of a secondment arrangement, it was held by the revenue that this cross charge is taxable as a fees for technical services, because technically the person coming to India is rendering services and making technical knowledge and skills available to the service recipient, and that's why it is nothing but a FIS or a FTS taxable. But when the High Court it traveled through the tribunal and then it reached to this High Court level, what was observed was that the employee was delivering the services using his technical knowledge and skills, but it was nowhere kind of a passing on its technical capabilities. And what was the payment going outside was a mere reimbursement of a salary cost. There was no profit element added to it, and that's why it is not taxable as a FIS. And given that there is a withholding done under Section 192 already on that transaction, and accordingly, this has been demonstrated by the master agreement entered between the two companies, under which the secondment has been made. And that's why this Flipkart came as actually a savior after the Supreme Court ruling in case of Northern Operating Service Systems, because that ruling would have laid or opened the Pandora box of taxability of secondment arrangements as a FTS. But this is kind of a breather that has been provided. And accordingly, this ruling can be followed for the subsequent secondment arrangements as well. Similar has been held in the next decision, which is on the next slide. In case of DLF projects, again, a project management expenses or a manpower supply agreement was supposed to be treated as taxable or no, and the payment was made with the markup added into that. The secondment arrangement had a markup also topped up into that, and though there was a markup element, but it was concluded that it cannot be said as a technical service made available, because the secondment arrangement doesn't give away the technical knowledge or skills of the secondee. It just delivers the services using the technical knowledge and skills. So these are the recent trends on the make available issues, which we have seen in last few years. And if we go to the next slide, which talks in nutshell about the FTS taxability and the withholding requirements. So if we see the movement on this slide, and if we have to just broadly summarize, is that when a FTS article kicks in, you have to, or a transaction kicks in, you have to test it under the DTAA, because Act definition is pretty wider. And if you go through the DTAA under the treaty on the right side, then you have to see whether it is covered under the business article or income from other sources article, if you are falling out of the FTS definition under the respective Article 12. And accordingly, you have to test it and determine the taxability under the respective treaty under the right side on the gross basis. If you form a P, you have to go through the P route. If you don't form a P, your taxability is stopped at the article level, and you may come out of the tax net if you are neither having a P in India. Your income from other sources article is also, I would say, very carefully has to be looked at, and how the wordings of the income from other sources article is there, because income from other sources articles leads to your taxation under the domestic provisions of the Act, and under the domestic provisions, you don't have an option of a net basis of taxation. It has to be at a gross. So you may end up paying a taxes on a higher side. And if there is a P, then you have to go through that series of complications, look at the attribution of a profits, determining the net profits, apply the 40%, and carry the series of compliances. So though looks a little complicated, but if you go through each step at a one time, then you can test the FTS taxability under the respective clauses. So this summarizes about the taxability and the withholding, consequential withholding implications on FTS. We will be happy to take the questions, but meanwhile, in the interest of time, I would request my colleague Akash to take us through the dividend topic, and then at the end, we will have the question answers to be taken. Akash, over to you.
Yeah, thank you, Padmaja. So we will now discuss on the dividend topic. So for ease of bandwidth, I'll just switch off my video for some time. Yeah, so dividend is taxable whenever dividend is being paid by Indian company to a foreign company. Then we need to see the taxation under the Income Tax Act as well as the taxation under the tax treaty. So under the Income Tax Act, earlier there was dividend distribution tax, which was abolished in on 1st April 20 with effect from 1st April 2020, and withholding tax was announced for dividend, stating that dividend will now be taxable in the hands of the shareholders. So just going to the previous slide. So under the Income Tax Act, where dividend is taxable in the hands of the shareholders, then shareholders, which are the foreign entities, there the taxation sections which come into picture are section 195 read with section 115A. So section 115A stipulates 20% tax rate for dividend. And under the treaty, there is Article 10, which talks about the dividend taxation. So generally, the tax rate for dividend is between 15 to 10%. And where there is a P of the foreign company in India and that dividend is attributable to that P, then Article 10 will not be considered and Article 7 needs to be considered, which is business income article. So what are the key conditions when we are evaluating the applicability of treaty rate in case of dividend? Because while the income tax provides for 20% plus surcharge cess rate, the treaty provides for 10 or 15% and 5%. One of the very important condition is that the recipient of the dividend, that is the taxpayer, should be the beneficial owner of that dividend. This condition is not there for royalty and FTS. And this is a very peculiar condition there for dividend income. At times it happens that the companies, they incorporate their parent entities in a particular jurisdiction just to avail certain tax benefits. And there is no commercial rationale of having a parent entity in some jurisdiction. For example, we can take a company is incorporated in Mauritius and a subsidiary set up in India. So in this case, the tax authorities primarily look into that whether the parent company who is earning the dividend from India is the beneficial owner of the dividend income. So what are the tests which they generally apply for determining this beneficial ownership? One is that whether the foreign company who is earning that dividend income has the right to that dividend income. Can that foreign company decide the economic fate of that dividend income, how to use that income, what to do with that income, whether there is any back-to-back arrangement to further distribute this dividend which is received from India to any other foreign company. What was the commercial substance behind setting up this foreign company? Was it only to obtain the tax treaty benefits, or was there a particular commercial rationale? And what are the underlying documentation which is available, which will be able to substantiate this? So if all the tests are, while this is a very illustrative list, there are other tests as well, such as there should be a proper board for that company. Decision of the dividend income should be taken by that board. So keeping in mind all these conditions, we will have to evaluate that whether the foreign company is the beneficial owner, and accordingly the treaty eligibility can be determined. Second condition, as I discussed some time ago, is that the dividend should not be related to the PE in India. So the foreign company earning a dividend income should not have a PE in India, and this dividend income should not be related to the PE. If it is related to the PE, then the lower treaty rate cannot be availed, and it will be taxed as business income in the hands of the foreign company, which is at the rate of 40% net on net basis. So while we discussed about the dividend tax rates, now we come to a very peculiar controversy, which is circling this dividend taxation. So as I mentioned, that withholding tax was introduced on dividends with effect from 1st April 2020. And the tax rate in India is 20%, whereas certain treaties provide for 10 or 15%. Now, in addition to this 10 or 15%, there are few treaties, very few treaties, which provide for 5% withholding tax rate. Now, certain treaties have a most favored nation clause in their tax treaties, which I'll quickly explain you the most favored nation clause. So most favored nation clause says that, so for example, we will take the Switzerland treaty. In Switzerland treaty, while the rate for dividend is 10%, in the protocol for India-Switzerland treaty, there is a clause which states that if India enters into a treaty with any other country subsequent to this treaty of India-Switzerland, and the rate of under that subsequent treaty is lower than this rate under the India-Switzerland treaty, or the scope is narrow, and the subsequent country with which the India is entering a treaty is a member of OECD, then for the purpose of India-Switzerland tax treaty, we can use that lower rate or we can narrow the scope. So this is what the most favored nation clause states. Now, basis this most favored nation clause, the countries having this most favored nation clause were adopting a lower rate of 5%. And once the country started adopting the rate of 5%, then the controversy began, wherein certain Indian courts held that 5% should not be available. In this case, recently there have been favorable rulings in case of Concentrix Netherlands and Nestle SA, which were entered by Delhi High Court, which have upheld the 5% withholding rate, stating that 5% MFN benefit can be availed, and basis that 5% withholding can be adopted. However, pursuant to these rulings, the Income Tax Department has filed a further appeal with the Supreme Court, which is now pending for hearing. And the hearings have conducted on 23rd February, and the final verdict is awaited. So I'll come to this rulings part once again, but before that, I'll explain on the international rulings on this front. So there have been international decrees by Netherlands, France, and Switzerland, wherein those countries have adopted that 5% tax rate should be available, while this is a unilateral decree and not a bilateral one. Netherlands, Switzerland, and France in their own country have passed a ruling stating that 5% should be the eligible rate under the India-Switzerland, India-Netherlands treaty, since there is a MFN clause. However, considering all this, recently in 2022 February, CBDT came up with a circular stating that MFN benefit would be allowable only in certain conditions. They have given 4 conditions for that. First condition is that India should enter into a treaty with another country subsequent to the treaty of the assessee. Then the other country with whom India is entering into a treaty should be a member of OECD at the time treaty is being entered into. Third condition was that the subsequent treaty provides for a lower rate or scope. And the fourth and the most important condition is that India should issue a notification allowing the benefit of that MFN separately. So there is no automatic benefit which you get, and there should be a specific notification. Basis this ruling, the court started adopting a negative stand in case of assessees. And since this is pending into the Supreme Court, the Additional Solicitor General N. Venkataraman, who is appearing on behalf of the revenue, has made certain arguments saying that this circular is valid and the benefit of MFN should not be allowed. So one of the argument which he has made is that in case of so where we are using the MFN for 5% rate, 5% rate is generally there in India, Lithuania, India, Colombia, and India, Slovenia treaties. So these treaties were signed. So Slovenia was signed in 2005, whereas it became a member of OECD in 2010. Lithuania was signed in 2012, but it became a member of OECD in 2018. And similarly, Colombia was signed in 2014, but it became a member in 2020. So you can observe here that all these countries became a member of OECD after their signing date, and they were not the member of OECD at the time of signing. So pointing this, the Additional Solicitor General said that when the negotiations go on at the time of signing, a country, whether a country is a member of OECD or not, plays a very crucial role, and basis that the negotiations happen. So allowing the benefit of that rate under that treaty, when that treaty was not a member of OECD at that point of time, will hamper the negotiations which the diplomats do while signing the treaties. And basis these all arguments which are made, Supreme Court is yet to pass the final verdict on this matter. So once this verdict comes out, I think the matter will be settled on whether we can use 5% rate under MFN or not. Going forward, while there was this controversy on the MFN rate, there is another controversy which pertains to the pre-withholding tax era on dividend. So earlier, while you all may be aware that there was a dividend distribution tax applicable on the dividends. Under dividend distribution tax, the Indian company declaring the dividends to the foreign companies or to any other shareholder has to pay the dividend distribution tax in India. At that point of time, whether treaty rate can be used or not was the question under consideration. And some of the taxpayers, they applied the treaty rate, saying that the treaty rate is 10%, and so we should so tax rate should be 10%, not the DDT rate of 20% plus surcharges. In that case, the assessing officers initially disallowed the claim, stating that treaty benefit cannot be allowed. But the Delhi and Kolkata tribunal, in case of GSEC, Dividend, and Indian Oil Petronas, they issued an order in favor of the assessee and allowed the DDT rate to be considered. And primary arguments, which observations which the tribunal had made, was that DDT is payable by the company. Like, though the DDT is payable by the company, it is a charge on the shareholders, and it is the cost of shareholders. And it was for mere simplification purpose and ease purpose that DDT was to be paid by the companies and was not recovered from the shareholders. However, when this matter came up again in Total Oil India Limited, at that point, Mumbai bench of tribunal, they found that this needs further attention, and they have placed this matter before a special bench. While placing this point before special bench, what observations they made was that the credit of this DDT is never available to the shareholder. So saying that this was always a charge which is borne by the shareholder may be inappropriate. Also, DDT is not a liability which is paid on behalf of the shareholders, but DDT is a liability of the Indian company. If DDT is not paid, the tax authorities will catch hold of the Indian companies, and it will not catch hold of the shareholders. So basis this, this case was referred to the special bench and is now pending for adjudication there. While this may have a enormous impact on many companies' taxation, since earlier all the companies have been paying DDT and the lower rate was not availed. So once this ruling is out, then we can see that many MNCs join these companies, and they also apply for a lower rate. And then we can see that post tribunal decision, how this appeal goes ahead to High Court and Supreme Court. Yes, I think so. Primary, these were the tax implications on dividend. And I would like to invite Padmaja again here to take us through the eligibility criteria for claiming treaty benefits.
Yes, thanks, Akash. And thanks for briefly taking us through the very important and relevant topic of dividend taxation. Post the change in the taxation regime, basis the moving to the withholding regime as against the DDT regime. And with this, actually for taxation eligibility or a impact assessment of a royalty, FTS or a dividend, the treaty becomes a paramount important. And that's why, while the Act provides for the higher rate of taxation now for all three categories, as high as 20%, the treaty is the only savior for a non-resident to get a better rate or have a lower taxation impact. But accessing the treaty is becoming more and more crucial in light of this controversy on the dividend taxation, what Akash just alluded to us, be it a make available concept under the FTS, or be it a royalty interpretation of issues of the copyright versus the property or the right in the product. And that's why one has to look at the treaty interpretation, be it a third-party transaction or a group entity transaction, more closely. And accessing the treaty has to be looked at in the four main baskets. Is basic, the treaty access is to the person who is a resident of that country, who is eligible to access that country, and not a pass-through entity like Mauritius, Cyprus, who actually lack of a substance there. Secondly, for example, accessing the lower rate under the dividend, you have to look at the beneficial ownership, which is also defined in a specific article of the dividend. And there are threshold criteria being given in certain treaties like Singapore or Mauritius, that you have to have a minimum threshold and a minimum period of holding to access the lower rate of dividend taxation. There, your connection with the PE also has to be very closely looked at, as explained by Akash few minutes back. And then third bullet important is about the anti-abuse norms. In the domestic provisions, we have a general anti-avoidance rules already introduced few years back. Similar line, there are the two important developments happening under the treaty in light of BEPS action plan and the multilateral instruments, which are actually modifying the different treaties across the countries by introducing the principal purpose test, that you are eligible to claim a treaty benefit if you are able to justify this principal purpose test. And there are certain limitation of benefits articles introduced in few treaties like Singapore, Mauritius, to restrict your treaty access, which has to be looked at. And last but not the least, there are certain requirements like having a permanent account number. There is a section 206AA, which talks about applying a higher tax rate if you are not matching up with minimum requirements. If you don't have a PAN, is still fine, but are you able to produce certain documentation like a no PE certificate, or TRC, no PE declaration, or TRC certificate, a Form 10F, which is a more online requirement which has been mandated by the government, which is relaxed for a few months right now, but it is a mandated new requirement. So that's why for any non-resident transaction, a cumulative and aggregating impact analysis under these categories or the criteria becomes very important before we conclude about taxability of any of these transactions under the respective treaties. So with this, I think we have concluded our presentation. We can pick up the questions which are there in Q&A box, and we are happy to take the live questions as well after that. So I have already answered a couple of questions live in the chat box. We can take the rest of them. So there is a question from Praveen Jain, where it has been, he's mentioning that export consultancy charges paid to a person of Indian origin who is now a resident of, who is non-resident in UAE, basically a UAE. TRC not provided, not taxable under UAE DTA, but technically not taxable under UAE India DTA, he has to justify his eligibility to access UAE treaty basis the TRC and other documents. If the TRC is absent, I'm not really sure whether how can we determine his eligibility to adopt the UAE treaty benefit. And in such a case, while preparing the form 15 CB, if you have to declare it as a nil and the TDS is done at 10.4, is this stand okay? So basically the TDS is done, but taxability is accepted as nil. So if the TDS is declared and that has been specifically covered under form 15 CB, then it should be okay. And now it becomes 20% yes, plus surcharge and says April effective. But so again, any transactions which are entered or paid, any payments after April 23, you have to apply the new treaty rate. But this, new act rate of 20%. But in your case, in the past, you adopted the domestic act rate of 10%. But if your transaction is spill over to April, post April 23, it is difficult to, go ahead with the 10% rate. You may have to adopt the 20% or the treaty rate. So technically, you may have to go to the rescue of India UA Treaty of Nil Taxation as against a 20% withholding rate. So those are my prima facie comments. But the query looks little complex. We'll be happy to take it live right now or later also.
Yes,
There's
and just one point to add
Yeah.
here, Praveen. So while Padmaja has rightly answered all the points of this query, as per section 90, subsection 5, so TRC is a very mandatory document which is required to take the benefit of the tax treaty. So if TRC is not available, then it may not be possible to take the benefit of the treaty, and especially considering that online form 10F regulations have come in, while they have been extended, relaxation has been extended till September 24 for those companies who do not have a PAN. So going forward, government is going to ask to submit the online form 10F, and while submitting the online form 10F, TRC is also a document which needs to be attached therein. So TRC is a very important document here, and if TRC is not there, then it may be difficult to claim the treaty benefit.
Yes, and then you may have to go to the domestic rate, which was earlier 10 and now 20. Correct? So then they can't continue with the 10% rate. Yeah. Akash, you want to take the next question from Ujjwal
Yes,
Jawar?
Padma. Yes. In case if any Indian client is availing service from a consultant in the nature of professional service in Singapore, will the same be taxable in India if it is resulting into sales from India? Will the answer change if the consultant is providing advertisement services or any other technical services resulting into the sales from India? So, Ujjwal, so here what we will have to see is what is the nature of that service. So as Padmaja had mentioned that FTS has 3 pillars, which is consultancy, managerial and technical. So if the nature of this service which is provided falls in any of those pillars, then we can tax it as FTS. And if it does not fall under that FTS criteria, then we will have to see whether that income which is being earned by the foreign company, whether it is in the nature of their business income. And if it is in the nature of business income, then it will be taxable as per P conditions.
Right. So basically, you have to see that if it is a professional service, but it qualifies as a technical or consultancy, it will be taxable. But in case of advertisement services, again, if it is just a non-technical consultancy, but just a more of a agent's role, then still an argument of non-taxability can be explored. Yeah. I think the next question from Ujjwal is on the dividend angle and the P related concept. Akash, you
Subsidiary, yes,
Yeah.
sure. Subsidiary shall not be considered as having a P, as there is a separate entity in itself. Having a parent company, need to understand from yes. So subsidiary, so OECD has laid a guidance on this, and in the OECD commentary, they have specifically mentioned that subsidiary will not be automatically considered as a P of the foreign company, and if the certain activities are carried out in subsidiary, then only P evaluation will be required. So if subsidiary is functioning as an independent entity having its own separate business, then the question of P does not arise, and where the dividend is being distributed, then we can consider it as a dividend payment, and P questions will not arise in that case.
Yeah, not effectively connected with P. That argument can be taken for the dividend. There is a next question from Simran Bhojwani, where we say that company have a P in India, then why the transaction are routed through P directly? If they are routed directly with P, then section 195 would not be applicable, right? Section 195 is very broad section. It talks about any sum which is taxable under the provisions of the Act and paid to a non-resident should be subject to a tax withholding in India. So if there is a income earned by a non-resident, which is effectively attributable or found contributable by the P of that non-resident, then you are still liable to do the withholding under 195 because it talks about any sum, which include royalty, FTS, dividend, and even the business income. And business income gets taxed the moment you trigger a P exposure. So your business income is there, it is taxable because you have a P, and you have to calculate the net basis taxation, but in absence of a proper calculation, you are still liable to do the withholding at a highest rate of 40%. So having a P in India doesn't take you away from the 195 compliances or the implications. I think there is a question from Manoj, and then maybe last question, Ujjwal, from Ujjwal you can take, Akash. Whether treaty benefit can be taken based on application made for the TRC certificate by NR. However, last year's TRC is available. Again, an interesting practical question which we come across with a lot of our clients. Ideally, TRC is issued on a yearly basis by any countries. So what we suggest to the clients at the withholding stage, if you are claiming a treaty benefit, a non-resident, he can propose that my application is made, which is under process. Last year TRC is there. A view can be taken basis that last year's TRC and the application state that the withholding can be done as per the treaty, or a treaty benefit can be taken. But an undertaking can be taken from the non-resident that in future, if the current year's TRC is not produced, any consequences for lower withholding or non-withholding that falls on the head of the recipient payer or Indian resident payer have to be borne by the non-resident, because unless and until TRC is finally issued by the authorities of respective country, you cannot conclude that the residency is approved. So it is kind of a commercial call that you can do that at a withholding stage, but whenever that non-resident wants to file its tax return in India because of treaty claim being made, it should have this TRC in place, because as Akash mentioned, for 10F filing also TRC is mandatory. So a stopgap arrangement can be done with necessary undertakings, but it can't be a regular action, but it can be a one-off arrangement that can be accepted.
Yes.
Yeah, Akash, you want to take the next?
Sure. So going to the next question. So if there is TDS deducted, should a foreign company obtain PAN in India? Is that beneficial or not? So Ujjwal, in fact, this is a good question, and this question has two facets here. So first is that under 206 AA for TDS deduction, there was a rule which was inserted which granted the relief, saying that PAN is not mandatory if you have a valid TRC, you have a form 10F, and certain documents such as tax identification number, name of the company, address of the company, all those documents are submitted, then PAN will not be required and the lower rate can be obtained. However, under the recent amendment, which has been brought with respect to online filing of Form 10F, as I mentioned, there is a relaxation till September 24 for those companies who do not have a PAN. So up till 30th September, we can adopt a position that PAN is not required, and we will take a lower rate and we will not apply the maximum rate of 20%, which is there in the Act. But after September 24, if this relaxation is not removed, then there will be a mandatory compliance of filing Form 10F online. And for filing the Form 10F online, a PAN number will be required. And hence, then the PAN may become mandatory in this case.
Yeah. And just to add one more point, I think if TDS is already done, then obtaining PAN may just help to report that transaction and claim any tax refund by filing the tax return. So this may be a subsequent activity if the TDS is already. I think the anonymous attendees question, not able to raise exactly the TDS deductible on customized software from IFCO. I think as we discussed that there is a Supreme Court ruling of engineering analysis. Any software sale which does not lead to transfer of a copyright in that product should not be liable for the withholding. But the fact pattern has to be studied carefully in light of the Supreme Court decision.
Yes. So
Yeah.
coming to next question, what if the work done in subsidiary is coming only from parent company? Yes, so this model is being followed now as well. So there are captive entities of the foreign companies in India, which primarily serve only the foreign companies. That is very well allowed under the taxation framework. The only safeguards which need to be maintained are that the Indian company is acting independently and is not acting or doing business on behalf of the foreign company. The work that Indian company is doing should be the business of the Indian company. So if those factors are considered and housekeeping measures are built in, then there should not be a risk of permanent establishment here.
Yeah, I think next you can take Akash and I'll take the last one.
Any liability arising for CA issuing 15 CB on basis of application for TRC, last year's TRC and undertaking as suggested by you. Yes, so if 15 CB is issued basis so if for the current year payment, what the law stipulates is that it should be a current year's TRC and not previous year's TRC. And if we are giving a form 15 CB basis last year's TRC, then it will be a non-compliance. And there are certain sections in the Income Tax Act which will then be attracted, and there should be certain penalty or other contravention related measures which may be adopted by the Income Tax Department.
Yeah.
Akash, I just want to add for this. What Mr. Manoj Shah is asking for, any liability arising for CA issuing 15 CB. I don't think CA is liable for any liability. The liability is always on the company, because the withholding tax is regarding the company or the
Correct, sir. I agree to that. In fact, I was going to add further. But as the professionally it is driven that the CA practicing in a own capacity, he should also appropriately take a necessary declarations from the company that this is their understanding the treaty rate is eligible, so that they are also protected from any professional non-compliances or a disciplinary action from the institute.
Yes, because otherwise, sir, then it will become misreporting. And since 15 CB is also followed by the bankers, then it will be once CA certifies that, then it is like then there's no further verification on those documents.
Yeah, it is always taken to take undertaking or some declaration.
Yes.
Yeah. Okay. The last one is from Bhakti. Hi, Bhakti. Good to see you in the session. So yeah. IT shared services, website maintenance services, recharge received from UK entity, whether such services covered under the make available services. Again, if it's a maintenance support activity or IT support activity, which is conducted, provided by the overseas UK entity to India entity, we can always in a general norm take an argument that there is no technical knowledge or skill imparted to the Indian entity. And the very nature of the recurring activity demonstrates that every time for this maintenance activity, you have to go to the UK entity. And that's why the UK entity is not passing on the technical knowledge. So it can be a good case to argue that it doesn't make available. But you have to at the same see that if UK entity is passing on any permanent knowledge or skills to Indian entity in this process. If no, then it's a good case to argue that it is not taxable due to make available clause. Yeah, Akash, the last one you want to take?
Software with few changes as per use of buyer can still be qualified as shrink wrap of the shelf software as defined in Supreme Court decision. Yes, that can be very well qualified as a shrink wrap software as long as the copyright in the software is not transferred, and what is transferred is the product to use. So, for example, if I purchase Microsoft's products, Microsoft Word or Google's product, then what I'm purchasing is a product and I'm not purchasing the software rights in it. I cannot customize that software at my end and sell to customers further. So I'm not basically exploiting the commercial properties of that software. In that case, this should qualify as a string wrap software only and should not be treated as royalty payment.
Yeah, means even any customization as per buyer's requirement per se doesn't take away its nature as a copyrighted product. As long as that every next customization, the buyer has to go back to the seller, and it doesn't enable the buyer to do it on its own in future, basically. Yeah. So I think we covered most of the questions in the Q&A box, right?
All questions we have replied.
Yes.
Yes.
Anyone wants to have any live question or any live point to add, we are happy to have that as well.
Ujjwal raised a hand. Swati, can we unmute Ujjwal?
Yes, sir.
Ujjwal.
I think there are two people who have raised their hand. Yeah, Ujjwal and Simran. Yeah.
Okay. Hi, Padmaja ma'am. Hi, can you hear me?
Yeah.
Yeah. Hi, Ujjwal.
Hi. First of all, thank you, ma'am, for a wonderful session. It was really helpful with all the insights that you gave. Just wanted one clarification on the part that that means the TDS has already been deducted, and now the foreign entity wants to claim a refund for that. So that is where I was trying to understand if we can take a PAN application for them and then claim the refund for that. It was not
Yes.
from an Indian company perspective; it was from the foreign company perspective.
Very valid question, Ujjwal, and this is a very practical challenges or issues foreign companies always face, that TDS happens at higher rate and they want to claim a refund. So they can definitely obtain a PAN and file a tax return and claim the refund in that return. But only point is that the period for which the refund has to be claimed, the window to file the tax return for that period should be open, because the windows have been reduced substantially in last few years. So if that is possible, you can always file the tax return and claim the refund of the excess taxes deducted.
Actually, ma'am, the only question in this, the problem that we were facing in this is in one of our situations, wherein in case if we're trying to obtain that means any kind of PAN registration in India, they wanted a place set up for that. So basically, they can get the PAN registration done for that, basis that. And in that case, if we try to take a virtual office, will that amount to a PE in India? And will the taxability change in that case?
So generally, for place of presence in India, we don't suggest to obtain an office or anything. You can, where your customers are located, that city can be chosen as your operational place, because you are rendering service from Netherlands to a Pune-based customer. So you can choose a Pune as a jurisdiction. You don't have to take any place, and generally the situations are so improved that they can get all intimation to their foreign addresses as well. And they don't need to hire any virtual office or an address place in India. That is mandatory in case of a TAN, but not in case of a PAN. Akash, you may just want to add to this point.
Sure, Padmaja, I completely agree with you. In fact, Ujjwal, on this virtual office, so there have been rulings. In fact, if there is a home office also, then there may arise a risk of P. So if a virtual office is being set up in India and office space or any other activities is being carried out, which primarily pertains to the foreign company's business, then of course this may give rise to suspicion over P, and tax authorities may further try to go into it.
You can avoid it for PAN. You can clearly avoid it. Yeah.
Okay, so just for obtaining the PAN, better not to take any virtual office, because that could lead to a P situation altogether.
Correct.
Okay,
that
and just
may not lead, but that may give some rise to suspicion.
Understood. Well, that would unnecessarily be a complication.
Yes.
So why have to just go in for that? And just one more question, in case that means I had raised one more question with regards to subsidiary. Shall not be considered as a P. That is what you have said, that even in the OECD guidelines, that is what has been mentioned. But what in case if the subsidiary is taking 100% of the business from the parent company only, and there is no other separate client for them, they are providing the services only to the parent company?
Correct. So usually in this case also, there should not be any risk of PE. The reason being that there is the foreign company is doing a business, and it requires the services. Now that foreign company can take those services from a third party or from its own group company. considering the commercial reasons, the foreign company decides to take all those services from the Indian company, which then becomes a captive entity of that foreign company. In that case, Indian company has been incorporated for providing those services, and the income which the Indian company earns from that foreign company is taxed in India. So in that case, since a separate business is being done by Indian company and not the business of foreign company, so the P risk then reduces, and there should not be any exposure in that case. So
Yeah.
while in India, there are many software companies which have the exact same model, wherein they have the captive centers here. So they take the services from Indian company, which are then utilized, consumed internally there, and they provide services to their foreign clients there.
Understood. Perfectly right. Perfectly right. Thanks, Akash.
Yeah.
Thank you, Padmaja.
Thank you, Joy.
Yes, thank you.
Just want to confirm, both of you, whether we can share this PPT with the participants.
Sure. So we will circulate it, Rajesh sir, and it can be, I believe, uploaded on the ICI portal, right? Pune branch.
Yes, right.
Yeah, we'll be doing that.
Manojji, I think this issue resolved. Next is Rajesh Kamath, whether Indian resident working from home as employee of Singapore company, will this be treated as PE of the Singapore company or tax credit of TDS by Singapore employer available?
Okay. So Indian resident working from home as an employee of a Singapore entity. Will this be created a PE of a Singapore company?
Yeah. So, Padmaja, should I take this question?
Sure.
Yeah. So, Rajesh sir, here where the Indian resident is working from his own home for the Singapore company, then there may arise a risk of PE. So there may arise a risk of fixed place PE here, because under the fixed place PE, there are three criteria. One is that business of foreign company should be done from India. There should be a place at disposal. And third, there should be a permanency which is involved. So this is the criteria for fixed place P. And second P, so even if we come out of fixed place P, then the service P exposure is also there. Service P says that any employee who is doing the business of foreign company and who is under the economic employment of the foreign company. Now, in this case, the Indian resident is the employee of Singapore company. So Singapore company then becomes the economic employer of this Indian resident. That is, the control and supervision is with Singapore company. And where Indian resident is doing the business in India, there may arise a risk of PE in India. However, under the e-funds ruling of Supreme Court, the Supreme Court has observed that if the services are not furnished to the customers in India, then an alternate view can be taken that P should not be arising in India because the customers are sitting outside India. But of course, the risk of P is there in this case.
Yeah. And in fact, working from home concept, which has emerged or developed in the COVID scenario, that period of 2 years, 2020 to 22, OECD had given some relaxations to avoid the PE cremation because of the people working remotely from their home country in a COVID scenario. But those relaxations were available only for that specified period. And since we have fortunately emerged out of the COVID scenario, now any such scenario by default will not be under the out of the tax purview and may have to be, structured or housekeeping measures have to be incorporated to mitigate any exposure.
Excellent. I think we have completed all the questions, including direct dialogues also with one member, Ujjwal.
Yeah, I think there was one more who had raised the hand. I'm not sure.
Simran had raised.
Yeah. In case she wants to take up any question.
Swati, Simran ला unmute करा ना.
Oh, sir.
सिमरन अनम्यूट कीजिए आपको खुद को. हाँ. You can directly ask. Simran, whether you want to ask anything?
Uh,
Simran has written that whether she is audible. So Simran, we cannot hear you.
yeah, we are not able to hear her actually.
Simran, alternatively, you can type in your question here.
Yeah, she has already asked, I think, question.
Okay.
Yeah. That a common company have P in India and all.
Yes.
Okay.
Okay. So, sir, consider this session is over. And also you agreed to share the PPT with the members. I really thank you, sir. Thanks to all of you, Padmaja madam, Akash and Sampada madam also for joining and enlighten all the participants on the very important subject. I think out of the 10 subject, this is today's topic is the only subject which most of the members are using in their day-to-day life or day-to-day practice. Every practicing member issues at least 115 CB in a year. So we have to take the provisions in consideration while before issuing such a certificate. And really you have elaborated all the provisions with case studies. Thanks a lot, Padmaja madam, Akash, for all your efforts to enlighten all the participants. You have accepted our invitation immediately and really taken all the efforts to clear all the doubts also. Thank you, Sampada madam also. On behalf of Pune branch, I thanks all the participants, my technical team. Really like to hear you in person. Being this is a virtual platform, we could not felicitate you in person. So definitely we invite you at Pune branch. We will offline felicitate you, ma'am. Thank you for joining this course. Thank you.
Thanks, Rajesh sir and the Pune branch for giving us this opportunity. And as you rightly said, this no topic can't be as relevant to all our tax professionals' heart, and especially in light of the change of the provisions in last couple of 1 month, 20% rate versus the treaty rate. So all of us have to evaluate the treaty eligibility for all these transactions. And on a lighter note, we imparted our knowledge, technical skills and all, but I hope it would not be taxable and it will be beneficial to all the recipients in a good way.
Definitely.
Yes, thank you so much. And we are glad to present on this platform. We'll circulate the day shortly.
Yeah, thank you. I just declare this session as concluded. Thank you.
Thank you.
Thank you, everyone.
Thank you.
Thank you.